This conference will now be recorded.
All right, thanks for joining everybody again. Today we're going to do rent determination. This is, I'm trying to do the high points of like a 2-day COS class in an hour. So hang with me, but I'll send out these slides so everybody has them for reference later. And this kind of came about for a few things. We've had some questions lately that brought this up, but more than anything else, Nancy's talked about it several times. We're getting close to a HOTMA implementation date, which is going to change the way that we do several things. There'll be much more training on that. But I thought it was important to kind of make sure we're rock solid on what we do now, so that the changes then and what is changing become clear once we get there. And I'll say this was even a good process for me to go through in preparing these slides. In doing calculations manually to determine the rent amount. It was really helpful to kind of put things in perspective and remind me a couple of things. So with that being said, let's go ahead and get started. So we're going to talk through income, assets, deductions, expenses, and other factors, basically everything leading up to the rent amount that a household pays and the HAP amount that HUD may pay on their behalf. We're going to do this kind of, I'll cite some examples as we go through it, and then in the end we'll kind of put it all together and do the calculation for TTP, tenant rent, HAP, so on. So let's start out with income. So this is the example, the definition of income from the 4350. It's all amounts, monetary or not, which go to or on behalf of the family head or spouse or co-head, even if temporarily absent, or to any other family member, or any anticipated to be received from a source outside the family during the 12-month period following admission or annual reexamination, effective date, and which are not specifically excluded by regulation. That number 3 can be a pretty big list. Things that are not explicitly excluded by regulation. Annual income also means the amounts derived during the 12-month period from assets to which any member of the family has access. It's important to note that the income includes the definition of income from asset, kind of all in one. We can kind of highlight some of these things that are bolded and underlined are things I wanted to point out. So number 1, monetary or not. That means if someone is paying your utility bill on your behalf, that's income. Even if you don't see the money yourself, that's income. Go to or on behalf of. And it's important to note there's a lot of benefits that maybe go to a payee, but if it's your income, regardless of who gets it. Shout out to Rosalind, who wanted to ask and make sure that I included that in here. The other thing I'll note, family member, that's important because it singles out live-in aides, right? A live-in aide may be a household member, but they're not a family member. So we're not concerned with the income of a live-in aide. Then are anticipated to be received, that's what we do, right? We can take a look at somebody's last 4 to 6 check stubs. That doesn't mean that things are going to continue that way always, but that's what we've got. We take what we get, we anticipate that income and annualize from there. And then lastly, on that asset part to which any member of the family has access. So kind of the reverse of Rosalind's point. If you don't have access to the asset, it's not your asset. It may be your income, but not your asset. Some common exclusions, and again, there's a whole list. I think it's 3 pages long of inclusions and exclusions in like 8-point font or something. That's exhibit 5-1 of the 4350, which is on the intranet. The most common we tend to see are earned income of minors. So if you're 16 and working at Sonic, your income isn't included. Groceries. So if it's food, if somebody is specifically buying you food or you're receiving food stamps, that's not income. Contributions paid directly to childcare. I don't think we see that a whole lot, but it comes up. Irregular contributions. So if you're looking at 6 bank statements and you see one payment where somebody got some money from somewhere, that's kind of telling me that it's not regular. Temporary or sporadic income, that can be tough to define, but that's along the same lines, right? If you're not seeing it pop up a whole lot, it's probably not something we need to count. HACA stipends that are $200 or less. Overpayments for SSI or Social Security. So if it's specifically for an overpayment, you're awarded 1,000, but you're only getting 900. The Social Security Administration is taking out 100 due to overpayment. That's excluded from income. Financial aid, those rules get tricky. I think I've about got it down where I don't have to look it up every time. But now they're about to change that. So I'll be looking it up again. And then lastly, lump sum payments. So if you receive $1,000, you're injured, you receive 30,000, that's not income. It's just a matter of what you did with the money, in which case it may be an asset. And again, the full list of inclusions and exclusions is Exhibit 5-1 of the 4350. It's on the intranet. So now we have a basic idea of what is and is not income. How do we tell how much income? How do we verify it? And HUD has outlined a verification hierarchy, which we've adopted. We have a verification hierarchy memo. And if I'm trying to get it down to one slide, paraphrasing a little bit, this is what I'd say. So at the top of this hierarchy is EIV and UIV. EIV is mandatory. We have to use it for annuals and interims right now. We also print it within 90 days of transmission of transmission of a move-in cert. And then in addition to that, Susan and Payal run a variety of reports either monthly or quarterly as required by HUD. So EIV is at the top of the list. Things like OAG and the work number are UIV, where we are tapping into a database and pulling out the data that we need. There are also some other third-party services that I know we've used before. So Thomas and Company, UVerify, and CC Verify are the 3 that I know of. But if a company tells you, we use CC Verify and you can sign up for an account, it's free. You tell them you work with the housing authority, they validate your login, and then you can get that info, that's great. The next step on the hierarchy is written third-party verification. And then within this step, actually, it kind of has 2 sub-steps. So the highest one within written third-party are things like check stubs or employment payment histories, things that are computer generated. The second level within written third party are things like VOEs or family contribution forms, anything that we send out, ask someone to fill out, and then they send back to us. Anytime we get below this point is where we need to have a verification hierarchy memo in the file explaining these are the attempts I made. I tried to send a VOE here, here, and here. The household doesn't have 4 check stubs. They just started this job. So then we went on to oral or self-certification. So for third-party oral verification, we have an oral employment verification form that you can use. Just document the answers as you're talking to them. We also have the verification hierarchy form that's a little bit more kind of a free flow. You can kind of type explaining that conversation. And then lastly, if we have to, or sometimes there's no other choice, it's self-certification from the asset. I'm sorry, from the household, not the asset. Self-certification from the household. And here we want it to be an affidavit. We don't want to put it on a clarification record. We want them writing it, them signing it. If there's a LEP or disability involved, then we can put it on a clarification record. We would still just ask that they sign at the bottom. Now let's get to calculating income. And this is true in general of income. We want to almost always annualize. I put the almost in very small fonts just to explain there are a couple instances where we would not annualize. There's a household at Santa Rita that I can think of that works for AISD. She's worked for AISD for years. She never works during the summer. And she's asked us, instead of doing all the interims to start and stop her employment, she just pays the same amount all year. So rather than taking her current income and annualizing it over 12 months, we've taken her current income and annualized it over 9-ish months. I think 42 is the number of weeks she works in a year. She prefers that. We're okay with that. But we're only okay with that because we know, we have this long history where she doesn't work in the summers. We're confident in saying she's not going to work next summer. We're also confident that she understands, even though she's not working in the summer, she still owes that same rent amount. So just because she's off, it doesn't mean it's she doesn't have to pay or her income goes down to zero. It's just that the other 9 months, her income is lower than what it should be. So if you get into a situation like that, let us know. Otherwise, we're always projecting as though someone's current circumstances are going to last the full 12 months. When we are annualizing, I'm going to go through really fast. This is all pretty straightforward stuff, right? We would take hourly wages times the number of hours they work, times 52 weeks in a year. If we have weekly wages, we'd multiply by 52, bi-weekly by 26, semi-monthly by 24, or monthly by 12. There are definitely cases where it's not that simple. We'd love for them all to be, but we run into things like child support, I think especially. There's also some folks who work kind of day labor jobs where it's not necessarily consistent how often they're paid, how much they're paid. For those, we just really want to do as best as we can. If you can determine a pattern, like every week or bi-weekly, then that's what we go with. Otherwise, we'll just kind of total up what we have for a month or a week, whatever works out, and then annualize it that way. Gig economy, we see a lot of stuff. So things like Uber, Instacart, DoorDash, we're seeing it more and more. They should be able to log on through the app and get us payment histories, whether it's a month payment history or a week payment history. If we can ask for that, get the screenshots, get whatever we can. I think a lot of them even have monthly statements. Get those, and then we can use that to annualize income. And all this to say, there's still some weird stuff out there. So if you feel like you need help, let us know. LIH service request, and we'll take a look. So here we're going to go with an easy example. We've got 4 pay stubs here. You can see they're all consecutive. They're bi-weekly. So if I'm calculating this manually, I'm just going to add them all up, divide by 4, and multiply by 26. That's going to give me an annual income amount of $26,468. This is what the calc sheet is doing behind the scenes. You would enter these 4 check stubs, and then for periods, you'd equal 26, and it would come out to this same number. Also point out, we should never round until we get to a field that's on the 5.9. So take a 5.9 out, look at it. When you're talking about income, it's the income source. If you're talking about assets, it's the cash value or income from assets. But you're not rounding up until you get that point. This was probably the most miraculous example that I found with these check stubs, because there is no rounding. And I thought that was pretty amazing to average 4 pay stubs, get a whole amount divided by 4, and still no rounding, but here we are. Here's some non-traditional calculations over here on the right. On the left, I think I'm the only one that does this. That's not true. OC needs to do it. You can see these dates are exactly a week apart. I would do this just times 52. It's the same amount every week, 79.38 times 52, and this would be my annual amount. Over here on the right, they're nowhere near regular. These three are a week apart. These are 2 weeks apart. That's a week. This is 2 weeks. So it's all over the place, right? With these, I would just add them all up, divide it by the 3 months that I'm using, and then multiply by 12 to get the annual amount. And I'll say, I noticed later I cut off the screenshot. This form was printed in mid-January. So I know that all of December was accounted for. I'm not shortchanging anything in December. If there was a later payment in December, I would have done this differently. Or if we were printing this form on December 12th, I definitely would have done this differently. Clear on this? Okay. So let's talk assets. This is also from the 4350. Assets are items of value that may be turned into cash. A savings account is a cash asset. The bank pays interest on the asset, and the interest is the income from that asset. Some tenants have assets that are not earning interest. A quantity of money under a mattress is an asset. It's a thing of value that could be used to the benefit of the tenant, but under the mattress, it's not producing any income. And some belongings of value are not considered assets. Necessary personal property is not counted as an asset. And again, there's another exhibit, 5-2, which summarizes assets, and it is also on the intranet. Like income, there are asset exclusions. And these are kind of the three I thought of. They're probably the most common. So necessary personal property. My car gets me to and from work. It's not like a hot rod that I use on the weekends, so it's not an asset. Term life insurance is something that doesn't have a cash value. It only has a cash value if you die. So it is not an asset. And then lastly, to our point earlier, if it's not effectively owned by the household, it's not their asset. When it comes to income from assets, there's kind of a two-part test. We do actual income from assets, and then if the household's total assets exceed $5,000 or are $5,000 or more, then we do this imputed calculation. So for actual income, for example, a savings account with an interest rate, the interest rate times their current balance is going to be the income from asset. A stock portfolio, on the other hand, that pays dividends, the dividends are the income. If the household does have more than $5,000 in assets, then we use a passbook rate. So we determine the cash value of the total assets. If it's over 5,000, which is the case here, they have 4,000 in checking and 2,000 in cash, then we just total them all up and then multiply that total by the passbook rate to get, in this case, $3.60, which on the 5 down would be rounded up to $4. One of the things I wanted to show with this example is I think I have this sense anyway, residents feel like they need to hide assets or, it's going to have this huge impact on their rent, and it really doesn't. So household one has a total of $800 in assets. It's $150 in a checking, $250 in a savings, and $400 in cash. The only one that has any actual income is that savings account with 30 cents. If you look at household two, they actually have 10 times the amount in those same assets. So instead of 150, it's 1,500 in their checking, 2,500 in savings, and 4,000 in cash value. Instead of 30 cents for actual income, it's $3. And then even with $8,000 in assets, we imputed it, it would be $4.80. So that would translate to $5 in income from assets. Does anybody want to guess or do the math really quick on what $5 would mean to rent? It's about 13 cents. It's 12.5 cents would be the impact to their rent, which is either zero or at most $1, depending on where and how the rounding works. So it's a really, really small impact, if we're honest. So now that we have income and income from assets, it brings us to our first field that's actually on the 5.9, the total annual income. So here we did our check stub average. We came up with 20, or divided by 26 to come up with $26,468. We added our $5 in income from assets. We have a total of $26,473, and that's total annual income. So before we talk about deductions or anything else. Clear so far? All right. Let's jump into expenses and deductions then. So deductions are easy, so let's start there. The dependent deduction for every household that's for every dependent in the amount of $480. This would include household members that are under the age of 18, a person with a disability, or full-time students. And B and C, they would have to be designated as dependents. So it's not like if someone is 64 and actually the head of household but disabled, they don't get a dependent deduction themselves. They're the head of household, they don't get that. You have to be labeled a dependent to get the 480. So minors, right? People with disabilities who are designated as dependents, and then adult full-time student dependents. That is our first deduction. The second is elderly family deduction. So any family where the head, spouse, or co-head is at least 62 years or a person with disabilities, and that's per household. So if both the head and the house, for example, the spouse, for example, are both over the age of 62, doesn't matter. You just get the $400 deduction once. So again, head, spouse, or co-head can never be a dependent. And it's important to note changes in student status are not required to be reported as an IR. I'll get to the second half of that here in a second, but what that means is that if someone was a full-time student at annual, but they've since graduated, there's nothing requiring them to come in and report, hey, I'm no longer a student, for us to then take back that deduction. There is, however, for tax credit properties, this lease provision that they agree to notify us in writing if there's any changes to the student status of any resident. So a household member at Georgian, they do need to let us know, hey, I'm no longer going to school, or hey, I just started school. If they just started school, we can, depending, do an IR. But we also need to keep in mind the tax credit implications of this. Does that mean everyone now is a full-time student? If so, do we have a tax credit exemption for the student rule? And that's definitely a LIH service request situation. Let us know if you have any questions there. But we have to be really, really careful with all household members being full-time students at tax credit properties. On the elderly family deduction, it's worth pointing out that the definition for disability to be eligible for that $400 deduction is different than for households who may or may not be eligible for reasonable accommodations. So there's two separate definitions of disability in this regard. By far, the most common thing we see is receipt of Social Security or SSI. If a household member is receiving SSI or they're receiving Social Security and their original award letter says they qualify as disabled, that's all we need. HUD and the Social Security Administration use the same definition for disabled when it comes to the $400 deduction. And then households certainly can report on their 62nd birthday, say, hey, I want that deduction. Or if they become disabled throughout the year. In either case, they can report and we can do an IR. So now let's get into expenses. And there's 3 kinds of expenses. We're going to start with the disability assistance expense. This one's pretty rare actually, but it's listed first in the 4350. So it's the one everyone always trains on first. And actually I went to a training last week and I was like, why did they do that first? And then like, I don't know, 72 hours later, I started putting this together and I did it first myself. So I get it. So families are entitled to a deduction for unreimbursed anticipated costs for attendant care and auxiliary apparatus for each family member who is a person with disabilities, to the extent these expenses are reasonable and necessary to enable any family member 18 years of age or older to be employed. What that means is if I am caring for a disabled child and I pay for attendant care for somebody else, then to stay with them so that I can go work, the cost of me paying that care is covered up to a point and reduced from my income. Now I would only get credit for the amount that exceeds 3% of annual income. So we look at the total amount of income I have, we would calculate 3% of that, and then the amount of my expenses that exceed that 3% would be listed as a deduction. It would also be capped at the amount that I earn. So I can't pay $15,000 a year, but only earn 10. My deduction would be capped at 10. My expense would be capped at 10.
Brian, can I ask a question?
Yes, please.
Before you go on to the next slide. Do you get the deduction for an adult disabled person? Like say it was a child and they now are 18. Does the family get a deduction for that disabled child, or that is now an adult?
Yes, so that goes back to the dependent deduction, and they would be B here.
Okay.
The key thing is they have to be listed as a dependent.
Yeah, you keep it on. Yeah.
They couldn't be listed as an other adult or anything else.
Thank you.
Annette, would you mind muting? Or mute? All right. I think this is everything I just said before. So, for example, again, if I'm paying for attendant care, which would be like girling or something similar to that, and that care then allows me to go to work, the income we looked at earlier is $26,468. If the household's paying $2,000, then 3% of that income is $794. So the amount that exceeds 3% of the income is $1,206. So that would be my deduction amount. So just like $480 for a dependent or $400 for an elderly family, my disability expense deduction would be $1,206. Again, this one actually is pretty rare. We see childcare and medical much more often.
Hey, B, can I just ask a question?
Yes.
So I think I'm getting confused myself. So the household needs to be deemed a disabled household, and one of the 3 heads have to be disabled, right?
No, not necessarily. So 2 separate things. For the elderly disabled deduction, it has to be the head, spouse, or co-head.
Okay.
For the disability deduction, the head, spouse, or co-head do not necessarily need to be disabled. But
okay.
the household has to pay for something, right? And there has to be some expense which for a disabled member. So it could be disabled dependent that then allows allows someone else to work.
Okay. Got it.
Cool. Medical expense, though, to Payal's point, is dependent on the head, spouse, or co-head being elderly or disabled. So we must include the unreimbursed medical expenses of all family members, so not just the qualifying member, but all family members. And again, the medical expense deduction is permitted only for families in which head, spouse, or co-head is at least 62 or a person with disabilities. And it's the amount that exceeds 3% of income. We can use ongoing expenses that the household paid over the last 12 months and use that for the next year. We can also include past one-time non-recurring expenses that have been paid in full, but that's only at AR or IR. So we're not eligible to do that at move-in. But if they're under a payment plan for a past one-time medical expense, we can include those payments in the coming year.
Brian, so
Yes, ma'am.
if they have a payment plan where they're going to pay monthly and it's not paid yet, we don't give them the deduction, correct? It has to be paid?
I think we have to have verification that it is a payment plan before
So even
we
though
would count.
payments are not made?
Not made yet?
Yes, not made yet.
I would say that's okay.
Because I've told people no because they haven't paid.
So generally, we definitely want receipts
Okay.
showing proof of payment, but if it is a payment plan for a past one-time thing, that we can include.
Okay, my mistake.
And I would be a stickler for that. Show me a payment plan. It's not enough to show me 2 receipts where you paid $10, last month and this month. I can't necessarily assume that's continuing. I want a plan. I want to see where you agreed to pay it, in which case I'd be okay with including that. And I mean, to be clear, if they gave me 2 receipts, I would count that as $20, right? $10 paid 2 months in a row. I wouldn't count it as $120 where I'm assuming that's going to happen every month. Not without the actual plan. So for one-time medical expenses, we actually have a household that we're dealing with legal aid with this right now. We have 2 options. Really, the household has 2 options. If it's a past one-time expense, we can add it as an interim, but we can only add it up until their next AR, at which point we have to take it off. Or the household can hold it and we can put it on the next AR, which is going to be good for 12 months. So we can add that medical expense. The issue is, whenever your next AR is, if it's a month later or 8 months later, at that point, we're taking it off. If we save it for the AR, then you're going to get credit for that expense for the full year. And it's
Brian,
not an option to do an IR now and then another IR in 12 months. It's only good through the AR date. HUD outlines that clearly.
and Brian, is there like an expiration? Like, what if I say, oh, I forgot to claim this 2 years ago? From 2 years ago, can I claim it now?
I think, and Nancy probably has this memorized, I think there is a part that discusses within the last 12 months. I think that's the language they use. And I, like myself, I think I'm a little generous. Like I'll help them kind of move that year around. It's not necessarily, you know, if your AR date is January, I'm not saying all of 2023. I'll kind of give them this, you know, 12-month window. But I think that's the range we're looking at. Like it shouldn't exceed a year under any circumstances. But it could be that that year runs from, you know, March through the end of February, or it could be, you know, January through December. It just depends on the AR date. Nancy put a note in the chat. Let's see. We have the option to accept a self affidavit saying they will be paying the expenses the next year as an anticipated medical expense.
I was
Thank
going
you.
back, sorry, to the payment plan. So just like to clarify, if somebody's got like a $4,000 medical bill and they say, hey, I'm now making payments. I'm gonna make $100 a month. And so we're not gonna count 4,000, right? That's not, you know, been paid. But if they're saying I'm gonna be making $100 a month, assigned payment plan, I would take that. I would also take, okay, I've already made 2, you can see that 2 or 3 plus like the self affidavit. So what I put in was just a link, sorry, to some FAQs that HUD did, because someone was saying like, hey, and this gets even, I'm not trying to even go any grayer, but just to state like we're supposed to include anticipated medical expenses. So if we have thinking of the verification hierarchy, documentation of a couple of payments, and then anticipating to pay, I would take that. Sorry. And I'm 100% with you, Brian, about the time frame.
Nancy, so on the example that you just gave, so in that case, if you had the signed agreement and it was $100 a month, then we would just do that times 12 and just give the $1,200. Okay.
Yep, correct.
And again, just to reiterate Nancy's point, it's the $1,200, not the $4,000 total cost, right? Yeah. I think more often than not, we tend to, or at least I tend to get questions about things like medical supplements or vitamins. The key word in both of those cases, this is what HUD says, it must be recommended as treatment for a specific medical condition diagnosed by a physician or other healthcare provider. So my doctor would probably want me to take vitamins too, but I don't. If they were asking me to do it for a specific medical condition, then those hypothetical expenses could be used. If it's just to be healthier, they could not. Our next expense type is the child care deduction. And this kind of has 3 parts as well. So this is necessary to enable a family member to work, look for work, or go to school. They can't be child care expenses paid to a member living in the unit. So I can't pay my 17-year-old who lives with me to take care of my 15-year-old. That would be insulting, but I couldn't do it if I wanted to. I also couldn't do it because only those 13 and older are eligible for child care expense. If it is, if someone's 13 or older, it could potentially be a disability expense, right, that we looked at before, but it couldn't be a child care expense. We typically don't have a lot of issues on childcare. I'll say what I typically see is I get a lot of questions of Yardi doesn't match the calculation sheet. And I'd say probably 50% of them are that there was a childcare expense added at some point in the past. And then this year you're not taking it off or you're not updating it. It's just left where it is. The other thing I tend to see is just that it's entered in the wrong spot in Yardi. So, and I 100% understand because Yardi doesn't make it easy or clear. But there's 2 places to enter childcare expenses within Yardi. One is on the member tab where school or looking for work childcare should be added. The other is on the income tab. So you would put the, if it's childcare enabling a member to work, you would put that on the income itself in Yardi. You'd update the income, and then on that 3rd tab, I think it is, you'd update the childcare expense there. If it's so they can go to school or are looking for work, then that goes on the member tab.
Yeah, because I didn't know there was a difference. I haven't been separating it.
Now you know. I mean, intrinsically, like this is how it makes sense to me that if it's work, then it goes with the work. If it's childcare or school, then there may not be an income source to add it to. And so it goes on the member tab. And that's how I remember to keep it straight in my head. So we talked through income, assets, deductions, and expenses. Here's where we're going to start calculating income. So we're sticking with that $26,468 from the 4 check stub average from Walgreens. Regarding assets, we have the $1,500 in checking, $2,500 in savings, and the $4,000 in cash. This was household 2 from that asset example. Deductions, we're saying they have both, $400 elderly deduction and $480 dependent deduction. And then expenses, we're saying it's that $2,000 disability expense. And what we're doing from here is calculating rent based off of this. So our step 1 is to determine that total annual income. That's the Walgreens employment plus the $5 from imputed income from assets. Gives us $26,473. Step 2, in order to get into that disability expense, we're going to calculate what 3% of the household's income is. So we add the income from assets to the Walgreens income. We get $26,473 multiplied by 3% gives us $794. This is a 5/9 field, so we would round to 794. Drop the 19 cents. Now that we have that 794, we'll subtract that from the $2,000 disability expense. That gives us the disability deduction of $1,206. And then we can add that disability deduction to the dependent deduction and the elderly deduction, and that gives us $24,387. And this is adjusted annual income. This I'll also point out is usually where I start when I get the Yardi isn't matching my calc sheet question. There's as many things wrong, potentially, I feel like, kind of above this or below this. This is where I see, this is where I look. Does the adjusted annual income on the calculation sheet match the adjusted annual income in Yardi? If it does match, then there's something wrong with the UA or contract rent or number of mixed family members, something along those lines. If they don't match, then it's some kind of problem with income, assets, or expenses, or Brian's Excel skills. Step 5, now that we have our adjusted annual income, is to calculate kind of the standard TTP, which is the greater of 10% of monthly income. And that's that total annual income that we looked at before divided by 12. Option 2 is 30% of adjusted monthly income. Option 3 is just $25 minimum rent. So here we have all our math. The $26,473 is the Walgreens employment plus the $5 of imputed income from assets. 10% of that is $221 would be how much we'd round to. The 30% calculation is the $24,387. So that's factoring in the dependent deduction, elderly deduction, and the disability expense deduction. So 24,387 divided by 12 times 0.3 is 610 with the rounding. And then $25 is $25. So the highest of these three amounts is the 30%. And that's almost always the case unless you're talking about zero income. $25, we certainly have our share. We have several households who that's the amount they pay. Some go may lose a job but then gain another job. They may go back to that back and forth. Some are just kind of stuck at that $25. That's okay. The $10 or I'm sorry, the 10% of monthly income is pretty rare. I think I've seen it 3 times ever. Usually it means it's a whole lot of deductions, either childcare or medical. But in this case, the TTP would be the 610. It can get more complicated from here, which we'll talk about here in a second with zero HAP or mixed families. But once we have that 610, we're almost all the way there. That 610 is the TTP. When you subtract the UA, that gives you the tenant rent. So that's the calculation for how tenant rent is determined, TTP minus UA. To determine the HAP amount, it's the gross rent minus the TTP. Both gross rent and UA can be found on the rent schedule. If we do have another complicating factor like mixed families or zero HAP, with mixed families, what you do is you kind of determine a fraction. And so mixed families, what I'm talking about is households that include ineligible non-children. I'm sorry, ineligible non-citizens. They could be children or not. If someone is ineligible for HUD assistance, then essentially that household's HAP amount is prorated. So the example we're working through here is if you have 4 household members and 2 of them are ineligible non-citizens, then their prorating fraction is 1 out of 2 or 50%. So in our example, we take our 610, or we take our 390 HAP amount, multiply that by our fraction is 0.5. That gives us 195. That would be their actual HAP amount. We'd subtract that from the gross rent, which gives us 805 is their now prorated TTP minus the $75 UA, and their rent would be 730 instead of the 535. These are all things Yardi and the calculation sheet do. Just making sure this is the math, this is how it works. For zero HAP, it is complicated in that we now have a rent cap, which we've always kind of had for layered properties, but there's now a kind of a rent cap for straight properties. Before, it could be that you were, Elon Musk, whomever, right? You could be making a ton of money, and regardless of the amount you were making, you were still going to pay 30% of your adjusted annual income toward rent. Now, however, there's a cap. So if it's a straight property, that cap is defined as the fair market rent. These are amounts that HUD publishes per bedroom size every year. They usually come out in October or September, and they're effective October 1st. For layered properties, it's the lower of those three. So 30% of adjusted income, fair market rent, or the tax credit max rent is the most we can charge for TTP. And the calc sheet is also doing that. And a bonus slide for you all who are here. I'll send an email out on this either today, tomorrow, or Monday, probably Monday. But a COLA increase was announced today, just about an hour ago. It's going to be 3.2%, which is considerably less than last year. The COLA is the cost of living increase that applies to Social Security or SSI benefits. It also applies to veterans benefits. But they're increasing by 3.2% effective January 1st of 2024. In the past, we've had the ability to use whatever was on EIV we could accept. With HOTMA, however, that changes what we're allowed to do. So here's kind of the 4 situations for tax credit move-ins and add-ons. We'll start adding that COLA immediately for tax credit income calculations. For PBRA, ARs, IRs, or ICs effective 1/1/24 or later, we'll also start applying that COLA immediately. If it's a PBRA, AR, IR, or IC effective before 1/1/24, whatever shows up on EIV is totally okay. And then lastly, for PBRA move-ins, we'll include the COLA if it's not on the verification letter, which probably should be at that point, as of 1/1/24 move-ins. So I'll get an email out to everybody on this, but wanted to give y'all a heads up and a chance to ask questions on it since we're pretty much on the topic anyway. So any questions?
So we're just going to calculate 3% more than they're getting. Or do we need to get another letter after January?
For EIV, you can take, so if the resident agrees, so ARs and IRs, right, you're going to be using EIV. You would take the letter and multiply it by 1.032. Which is going to give you the current amount plus the COLA, and then you'd multiply that amount by 12. For move-ins, doesn't apply to you, CCP, but so you're not going to have to worry about it until after 1/1/24.
Okay.
At which point they probably will have a letter with it already included.
Okay.
The biggest thing I think is number 2. So PBRA, ARs, IRs, ICs effective 1/1/24 and after. If there's a 5/9 that's already signed and done, it is signed and done. No reason to go back and revisit. If, however, you're still working on it, even to the point of having a calculation sheet ready and having sent out the notice of rent change for them to come in and sign, we should update that amount. Again, this is an hour old. I haven't talked to Laura at all. We haven't obviously haven't sent out an email to everybody, but wanted to give you all the chance to hear it first. It may not be the first, but definitely won't be the last HOTMA surprise. Any other questions in general? All right. Well, thank you guys for your time, and we'll talk to you soon.